Hi, everybody. So for today, we have Julian Sanchez from Elan Capital, and we're basically going to discuss the differences between ground-up construction and multifamily value add. So the idea, thank you first for being here.
No, thank you. This is great.
Very excited to have you. I guess I want to start how we met. We were at a conference and multifamily conference, and as we were discussing, things that we had in common, I believe we were in the same market in Opelika. We had a bunch of units at some point, and I already sold those units. I think we had about 200 units there in that specific market. And Julian has been doing value add multifamily for a couple of years. He's going to tell us a little bit more about it. So, actually, as a matter of fact, let's start with that. Let's start a little bit about you. Tell us about your company, about what you do, and then we get more into the details.
Yeah. So me and my partners, I'm Julian Sanchez. Me and my partners and investors at Elan Capital, we acquire value add multifamily. Recently, also focusing on the assisted living facility asset class. But yeah, for the last 6 years, value add multifamily has been the focus.
Okay, great. And do you do it specifically in any particular cities that you work?
Well, we have a big footprint in the Midwest, particularly in like the Cleveland market. Also have property in Illinois, Arkansas, and here in South Florida.
Okay, great. Well, a little bit about me. So everybody knows we are a combination of two companies, Strategic Properties and then SP Developments. That's where the SP comes from. Strategic Properties nowadays manages 5,400 units in 4 different states. And SP Developments is doing development in about 1,600 units between South Texas, that's roughly 600 units over there, or 500 units, and 1,100 units here in Miami. And we're very busy. I'm guessing Julian as well. So I want to start the conversation with, why don't you tell us how you got into this? Because one of the things that I keep telling people is that there's no property management career. Like if you ask a 14-year-old, he's like, "Oh, I want to be a property manager," or "I want to." So the way that it's been for me, that this kind of happens, right? You stumble upon it, but how did you get to where you are? Can you tell us a bit about your story?
Well, the short and sweet of it is, I decided real estate was going to be the avenue to invest in after some other research, and then from there, it was like the different asset classes in the real estate. I'm like, okay, I know apartments instead of homes. Multifamily, met my partners, and we just started acquiring. It grew from there. And then to the point of property management, because we also self-manage our own properties, it just became sort of a necessity because, as other operators or investors may know, it's very hard to find good property management companies. So that's kind of it, the short and sweet of it.
Okay, good. And since let's start with acquisition, because that's where it all starts. I'm guessing, can you tell us a little bit of where do you get your product? How does that work? Can you basically teach the audience, in your own words, maybe not, I don't know if you have a secret sauce or something, but tell us a little bit how you are able to get to the units that you do get to, and then we'll talk a little bit about underwriting and so forth.
Right. For us, what has worked, and that's primarily my role, has been really broker relationships with, when it comes to the multifamily space, it is primarily, they are the ones that have the connections, the relationships. Even I've known, funny story, property in Ohio, I knew the owner personally, but he decided, they don't want the hassle. These are, as you may know, different types of investors and more sophisticated perhaps. They just want to they don't mind paying the broker. They just want to let the broker deal with the transaction. So, that's pretty much every deal we've done has been directly with a broker. So it's creating those relationships. And once you do close on those deals, so they're more inclined to send you more. And that's been pretty much, every acquisition we've done. So no secret sauce per se, but just demonstrating that you are capable of closing and you're a good operator.
Well,
yeah,
I was just going to say that because this market or in this industry is a far smaller than you can believe. So everybody knows everybody. And if you enter into a contract with a 30-day due diligence and on day 29, you start retrading, which happens a hell of a lot. Brokers will remember, and even, of course, owners as well, but maybe you don't think you're going to stumble upon the same owner, but for sure you're going to stumble upon the same brokers that are handling the transaction if there's two of them, and they talk. And they'll know, and they'll spread the message that you're not a closer, that you're not serious about the offer that you made, and so forth. So, I guess taking care of your name is it's really important.
Reputation is everything. Yeah, with brokers, with your investors, with vendors, mortgage brokers. I mean, yeah.
Okay, great. Now, let's talk about underwriting. So, what is it that you look for? Do you have let's say, a quick way of calculating whether a deal makes sense or not? Like before doing the whole underwriting,
right.
Like if you see 100 deals, can you just shuffle through them fairly quickly and then start digging into it? How do you do it?
A quick back of the napkin 1%, or really I just do it in my head, is like you'll look at 100 units. Let's say it's a $5 million purchase price, $50,000 a door. So I look at least a 1% minimum rent per door.
Okay.
Cost. So if it's $50K a door that I'm purchasing, rent should be minimum $500K. $500 a month, ideally more, but that's like the minimum. Or knowing, okay, if there's a value add component here where we can raise these rents, they're way below market, and that's where the value add comes in, right? Hey, we can raise these to 700, 800, etc.
Got it.
Here in South Florida, Section 8 is paying above market rates, and we've been getting, very high paying tenants thanks to through Section 8.
That's a good point. I might want to get to Section 8 in a minute.
Mm-hmm.
But for us, in development, we're sticking to very specific markets. So we know that, and of course, let's say Miami, for instance, there's plenty of neighborhoods with very different rents. We know that we have to start at a minimum of a rent. Right now, our minimum rent that we're looking for is $3 a square foot.
Okay.
So that's not everywhere. You can't get that just anywhere. So that takes out a hell of a lot of places that we will definitely not consider. Then from there on, we use a lot the price per door on the lot. So, for instance, if we want a piece of land that has an approved density of 100 units per acre, then, and typically here in Miami, it's more like 150 or so where we look at, but let's say for sake of simplicity, it's 100 units per acre. Then if they're asking, $3 million for it, so that's $30,000 a door. That's a really good way of saying like, okay, that's good price for that land.
So that's your good baseline.
Yeah.
Or kind of you.
We're between $35,000 a door all the way to the highest that we've paid so far. It's $65,000 a door. Very different markets.
Very different product.
One of them in very different product, but it's going to be somewhere in between. And since we know the rent per square foot in that area, that's where we need to get to first. Then we start going backwards and then do the whole model. But also, right now, there's few lots in Miami, really. I mean, so we actually get sent deals by brokers as well. But fortunately, lately, we've been able to get lots directly from our property management clients. So that's one way of getting assets. The other one is through having exposure on the news. So we get contacted by the owners themselves. And And there is a last one that's a funny component that's happening. I don't know if this is specific to also other Latin American countries, but since we're Colombian and I'm Colombian, we have a good network of Colombians that have been reaching to us. And the reason why is because Colombians, when they're buying land in Colombia, when they buy something is for the purpose of being involved in the deal all the way through.
Right.
So somebody buys a huge lot, he's not going to sell it. That's not the idea. There's no developers that are looking to buy into it because the costs of the financial cost of carrying over that lot through the entitlement process is too long. So what they decide is to partner up. They do a JV with that owner, so that the lot comes in, as soon as all the entitlement process is done and the permits are done. That's when they contribute the land.
A partnership is structured.
There's the partnership structure. So for us, they now want to do the same thing here.
Do you find that done here as common as well? Or?
Well, exactly. So the funny thing is, I've been approached by at least 3 different owners with Colombian
land here in
the U.S. that they own the land, and they expect to do the same thing. And here, developers don't really work that way. Developers want to buy the land, and that's it. Just get
take your money,
and go out of the deal. And they're like, no, I want to be part of the deal. Like, why are you cutting me out? I bought this land. I want to be. And then you ask, "What are you the developer?"
Do you know?
No, I have no idea. And you want to be a part? Yes, and I want to be co-GP, and I want to have some say in the things that are going to be carried out here.
Things that I know nothing about it.
And, right. So we stumble upon those type of owners a lot, and but it's good because we get those properties off market first. I think that we do have a special pricing in it, and the fact that I don't care to pay interest on or promote for that matter or return.
Just give a promote,
on carrying the land for a year and a half, that more or less is now we're taking an entitlement process. We might as well just have a set price that comes into the property 1 year and a half from the date that we started entitlement, and then the partnership is built that way. So that's I guess one different way of reaching.
Well, that's good. How would you structure it though? You say a year and a half into entitlement, like they put up the land. That's
correct.
Hey, they own the land free and clear. Boom, it's now part of the new LLC, I guess, right?
Sure.
Structure it, whatever equity split. A year and a half in, entitlement is complete. Is there a carve out there, or how does it? What happens there? Because you mentioned that.
So
point.
Good point. Well, first off, they would not be interested in just selling the property because they would have to pay taxes on it.
Mm-hmm.
So one way of structuring, and we did this deal for a property in the roads recently, is that they would put it into the equity into, well, they have the LLC that already owns. It's a single entity purpose LLC that owns the whole asset. They have 100% of the shares, and they'll start to move shares to us as we go ahead and capitalize the property. So they're not set there. They don't have to pay taxes on that sale per se, or not until the
sale.
Exactly. So in as the building as the building or the property, the project needs more funds, we start moving in more funds until we're 50-50 on the shares of the LLC. That's one way of doing it. There's no actual sale on it. And during that year and a half, well, we're putting in capital. We're doing the permits,
all the work,
the entitlement process, and then we start construction.
And thus, point to mention, you don't have that whole, like if you were to just buy it outright, you don't have that holding cost of the debt
exactly
during that period of time, which the land is just sitting there.
Exactly. There is, and you bring a good point there. Something that's very important in this industry, in both yours and mine, is leverage. And in leverage, it means I'm going to take it into different levels of leverage. One of them being, of course, the one that everybody knows, which is the bank. Then the other one is investors. And I wanted you to talk about these things as well and how you deal with those. Then leverage on other people doing work as well. Like you need to lever your capacities with other people's ability to contribute and work as well. So it's all really about leverage. Can you tell us a little bit about how you structure your capital stack per se?
Exactly. And it's funny you mentioned that. I was at an event this weekend, and there's a guy that quoted, or he calls it capital stack engineering. And I like that. They're like, exactly, because it's essential to what we do, really. And so structuring debt is an art. And then for us is relatively simple, but it goes into because that's just been our business model. We take value out of real estate, multifamily, stabilize within a 2 or 3 year period, refinance at a new valuation because now, the property is sound, better financials, etc. Pull our money out, our investors' money out, return it, and continue to hold the asset long term. That's been our strategy. So it's 2 steps execution, but it begins with the initial capital stack is typically some kind of bridge debt, or we've had success in certain markets like in Arkansas where local banks are just more involved and willing to be more, not as conservative, or just, hey, and we sit down with the bankers and explain it. This is our plan. The asset looks like this. It'll look like this once we're done. We'll take you guys out and then put long-term debt on it, a Fannie Freddie note. And that's been our plan always. So in short, yes, some kind of short-term debt, typically,
interest rates. How much do you think? Can you
we were, so 2 years ago when we pretty much, 2022, we kind of more than tripled the portfolio. It was a busy year. But at that time, even, our bridge notes, which we take out fixed, but they include CapEx budget and as well, but they were about 6%. Toward the end of that year, we were as high as 8.5%. I think nowadays the same product is double digits or close to double digits, so high 9s. But yeah, so right now, actually, we're at a point in time where we are doing the second part of that I was talking about, refinancing all those out. So recently we had one, again, long-term Freddie SBL note at 5.6. We locked in a good rate, I don't know, like 3 months ago. And then nowadays, actually, Treasury went up and we're refinancing the asset in Opelika for about a point higher. But hey, we'll pull money out, repurpose it. And then we did, this one is more of, so this one we're doing differently just because we think in 2 or 3 years we can do the same exercise at a lower interest. And for this one, we're not taking 100% of proceeds out, but just a portion, and then we'll redo the rest in a couple of years. So
interesting. So typically, you said typically investors would exit at your refi. Then.
Yep, and we return capital. So we've tried to velocity of money.
Okay,
and we've done it as quick as 13 months in some smaller assets. Yeah, typical 18, 24 months.
What's the appetite? What are investors looking for in terms of returns in your business?
I hear 18% IRR minimum is kind of just like the baseline.
How many years, more or less? You're between 3 and 5, or more or less?
Yeah, no, and we always structure 3. We do projections out to 7, as typical syndicators do. But yeah, with event happening at the year 3 mark, return capital, and then continue to hold the asset. But that's kind of like their benchmark, what they're looking for.
Got it. For us, it's not very different. I got to tell you, and that's one of the things that I wanted to explain, because when I started talking to Julian that last time, we saw that our businesses are far more alike than they're apart, and so our capital structure. Let me put it as an example on a $100 million building. So on a $100 million building, we're talking that land should be roughly about 15% of the cost. Let's say another 15% in soft costs. And then you have hard cost would be 70%. For those who don't know, soft cost is more like the architectural plans, permitting, anything related to entitlement. Think of it as non-bricks. Whereas the hard cost is anything related to the actual bricks and anything that goes physical into the construction.
including legal, interest, other.
Legal will be more on the soft cost. So
Exactly. So that
yes.
soft cost
Yeah.
includes all those.
Correct.
Okay.
And then hard cost is specifically down to the negotiated price that we have with the GC to build, for them to make the build the building per se. Now, that's also, let me just explain. There's what's called a GMP contract, which is a gross maximum price contract.
Right.
That's what we sign with the GCs. They basically tell us, okay, we're going to build at $165 a square foot, and we'll give you your keys if you pay us that money.
And that's it.
So going back to the example, that would be a $70 million check for the $100 million asset that I was just describing. Now, how do we get the funds for that? In construction, banks will always say 60 to 65%, 70%, regular banks. Now, I got to tell you, it's 60. Like, there's no way of getting around it. And as a matter of fact, with the reserves that they're requesting, which are not small, it looks more like 57%. Because they will
take in 3% of reserves.
More or less.
In an escrow account that.
Yeah.
Got it.
So let's say, for the sake of purposes, on the simple numbers, it's 60% loan to cost. Then the other 40% is going to come from investors, which we typically structure in 90-10. So we either bring a co-GP partner that would put in 90% of the funds, or investment fund, or a family office that wants to be an LP partner with us.
Typically one partner, though, or one large.
For that 90%, yes.
Really?
Yeah.
No raising.
No, we do on the other 10%. We raise family and friends fund,
okay, got it.
which is not very little money.
It's still
for
We're still talking millions of dollars.
Exactly. This example is $4 million. So it's and if you multiply, because right now we have $650 million in projects. Altogether, the small money, that's what we call that, like that 10%,
Small money.
It's like $30 million alone. So we are raising that with smaller tickets, friends and family, and then the bigger checks will come from investment funds or a co-GP partner. Now, once we do that, then our process is one year or 1 year and a half for entitlement process and permittings, then roughly 2 years, depending on the size of the property, to build, 10 months to stabilize.
And then from raw land.
Yeah.
Because you take it, and this is a question I was having in the last conversation we were having, because a lot of people don't know this. There's all levels of development.
Yes.
Where you can not yet even see a shovel in the ground, but the land has been developed and development has occurred. So,
yeah.
But you take it from raw land, because
so we have let me put it this way. I try to explain that as an elevator.
Yeah.
So think of it, ground floor elevator. On the elevator is where you have a cornfield, and we have one in Texas.
A little cornfield.
Just a cornfield. It's just it has corn and everything.
Good corn. Like
yeah. And now that land, we bought it for a certain price because it was a cornfield, and it has, let's say, a value of $10,000 a door.
Mm-hmm.
Then next process is zoning. So we're like, okay, we want to get this approved for multifamily. And
it's currently agricultural.
It's currently agriculture. So, but we need to go through the permitting process to tell the cities, like, we want to build some residences here. And let me explain quickly from the easiest to the most difficult for the city to accept is, of course, single family homes, because they're the less dense. Then townhouses, it's a little bit more dense. Then apartment buildings, garden style.
Many, right.
And then by floors, it's like, oh no, I want to put in 150 units per acre. Now you have to go 10 stories high. That's going to be a different density. Then you have the highest density possible that I've seen so far, which is the one in Brickell. It's 1,000 units per acre. 1,000 units. We have a project like that. And everyone's like, "Oh my God, you're going to build 1,000 units?" And no way in hell we're going to do that. Even though we have
You could.
we could,
Right.
yeah. Well, legally we can't. Now,
It comes down to feasibility.
exactly.
Like,
So once you go from agricultural to zoning approved for multifamily per se, now the land has a different value. Now I could go up
You
to
developed.
15,000. Yeah,
You have developed the land.
and $15,000, and then you get permits. So now you have something that has permits. Then you have a land with some work on it already, or with utilities, and then that has a different value. So the closer that you are to actually start the bricks, there's a few processes in between, and like I explained, it's like the elevator. Now, funny thing is, you can hop on and hop off the elevator anytime you want.
Meaning you can buy, sell, and there's people that just do the first step.
Exactly.
Or
There's
1 and 2,
people-
or take it from 2,
Exactly.
3.
Yes, they're entitlement experts. Like land, this is land banking. So land banking is whoever buys land for the sole purpose to sell it to a developer. They have no interest in developing anything there. We've bought properties all the way up with permits ready, like what they
Horizontal
call
development as
shovel
well?
ready.
Okay.
What's called shovel ready is like we can basically hit the ground, a month later after we close. We've done that, or kind of shovel ready projects, and then we've had the cornfield as well. So we've done everything in between. We have not gotten off the elevator really. We would like to take the project all the way to construction. So we don't sell land per se. We do get approached so many times on all of our projects. Just yesterday, I was called out as well. Somebody wanted to buy a project in North Miami. Like,
Just cold
so
call a
much
broker.
work. Yeah, no, I put so much work into this. Like, no, I want to see the building.
We want to see it.
Yeah. So that's.
But again, is that, well, I don't know if common or not, but majority of land developers just do certain steps and then sell
yes,
off, right?
Yes, they specialize. That's the cool thing. That there are. So it has its trade-offs, of course. Whoever buys something that's shovel ready seems nice, even though they're of course paying a premium.
They did, exactly. They didn't have to do the 2 years of work you don't
Right.
see
Yeah.
before the shovel.
Right. But the problem, so there's good and bad. So they don't have to wait as long to start building. They can move money faster. That's a good thing. The bad thing is they're paying a premium and they're not deciding on the design.
Right.
Like the design is
Already
almost set.
approved for the
Exactly.
city. Hey, this is what we're building,
Yeah.
or this is what they have allowed to build.
And that's the tricky part because, we have a property management operation like you do. So we're not thinking of this as a spec home that you just, hey, I'm going to build it and sell it. No, we have to manage this thing. So it better be the right number of units, the right
Layout,
layouts,
square footage.
the square footage, all these things. What amenities do they have? What is it that we can derive in rents from this? And more often than not, when you see the projects that are already so far advanced, it may just have a completely different idea of what we would have done in the lot. So
thus the strategy is you build, or SPs build, develop, and then sell. The buyer then uses you for management.
and then we also do the hold,
Yeah,
as
and
well.
some you hold.
Yes.
and some we
Yes.
hold.
You told me that last.
And some we sell. Like for instance, we will be selling the next project that we're developing in Fort Lauderdale. It's 110 units. The idea is to sell it right away once it's of course occupied, and investors are going to get their money
Will you
back.
be selling at CEO or at full occupancy? Or at 70%?
So
or-
great question. We have, well, as seen, and it happens to you as well, I'm guessing, we need to reach at least 90% occupancy so that the buyer can
get
the right
proper
loan,
debt, at
the
least.
proper debt. Now, this can be signed 6 months before, like even before the CO, we can sign the contract.
they'll just have the contingency. That
They'll have the contingency on the occupancy. They'll have a contingency on inspecting the property. So but it could be signed for before. I've seen it happen specifically in Flagler Village. Grand Cardone just closed on 4 buildings like a year and a half ago. Even like I want to say maybe a month from CO.
Right.
This CO is certificate of occupancy. So as soon as they reach the certificate of occupancy and they're able to occupy the property, they just go ahead and close right away. So, well, again, going back to what we were saying with investors, what we do, our exit, we try to just take them all the way through. Very similar as well to what you were just saying. We try to double their money basically in a 5-year span, which is close to a 20% IRR,
Correct.
internal rate of return. So
2x equity multiple.
Exactly. Let me ask you a hard question.
Hit me.
Well, and not judging, but would you be interested or not, or why not in development?
It has scared me, to be honest.
Please.
And that's why this conversation is so interesting. And when we first met, because I genuinely wanted to learn, and we've had the opportunities come up, and it just seems, and that was a conversation. So when we buy an existing asset and we know what we're doing, we're taking it, hey, we're increasing the valuation, doing these things. Typically, yes, it's heavily distressed, but it's there. We're at least having some cash flow coming in. And particularly your take, so raw land, cradle to grave per se, which is not common, right?
Yeah.
In the development. So we're talking ballpark, 4 years where no money's coming in?
Yeah, you're roughly, yes, that's
4
correct.
or 5.
Yeah. Maybe if I were a bigger project, might be 5. Yeah, but let's say, I want to say more like 3.5 to 4, because we're sometimes able to do entitlement within a year.
Okay.
And then a smaller project can even be built in a year and a half. So 2.5 years, and then 1 year to stabilize. So 3.5 years. So that's the least that we can go. But please continue. What are your what are you scared about? Like, tell me which things did you?
Well, that right there, it's like, okay. So
So not having the cash.
And the very first thing that comes to mind is like, okay, working for 3.5 years, or no money's coming in.
And no money's coming into the project. Okay, so let me explain it from where I see it. So for us, yes, the project
How do you structure the capital? Go back to even more capital stack engineering.
Exactly. So when I say $100 million cost, there's already a reserve interest for that whole construction, that whole period, and there's a contingency as well. So we basically know that we're going to take that long. And that's kind of part of the $100 million stack. So it's not like we need to bring $100 million and then another $3 million to pay for interest for that period of time. No, the $3 million is also, everything has to be planned from the start. And we know that that's going to be a cost. The other thing is, for us, it's not like SP Developments doesn't get any money through this project, because I take kids. I need to pay my groceries. I need to eat. Yes,
there's a development fee, right?
Exactly. So correct. We have a development fee. Typically, it's going to be in the market would be 4.5% of soft and hard cost. So that's a significant amount, and that pays the bills. That pays for our operation going on and for.
How is it paid? In what tranches? Or in what?
So I've seen it paid straight up linear. Like you just divide the 4.5 total cost of the project within the project, the 24 months that it's being developed, and that's how you get paid. We do it in that's some developers, but we do it by reaching milestones. So let me see if I remember. I remember seeing it very recently. It's 18% when we during the entitlement process, 18% or another 36% once we break ground, then another 18% when we get the CO.
At 18, like that.
They broke it. It wasn't me, but it was broken down that way. And so it's by timelines, and each project can be different. We
Mm-hmm.
have right now one that's very big. It's 644 units. It's 2 phases. It's in Hialeah.
In Hialeah.
We bought 21 houses and we're tearing them down and then developing 644 units just on that project alone. So it has to be in 2 phases. That's one of the ones that the exit is more like 7 years. So
What phase is it currently at? Cheers.
well, right now we still have half of the houses rented out to the prior owners.
Because you have to now you have people living there. So how does that
So some of them
extra
left.
mechanic?
As soon as when we bought the house, we had a contract with them
the
that
clause
they could stay for 8 months. So while they were looking for the new house with the
course.
money that we paid them, some took 2 months to leave and they left, and then the other ones wanted to stay even for more time, but now they're paying rent. And they're paying rent while we're doing all this entitlement process. And that kind of helps, paying that for at least the property tax for the land and some costs. But as they start leaving the property in about that's one of the ones that entitlement might take a full year and a half.
because you're now clearing, or
We're going to be demolishing the units. But the physical demolishing takes a week, really. Let's say 2 weeks, the demo. But we don't want to do it, right away, or at least we're waiting to do some of these units actually before the year. And I don't know, for those who don't know, that your property tax is assessed as of January 1st of every year, depending on what you have on the property. So if we have one of these houses that is not livable because they tore out a bunch of things as they left, and it's not rentable, then we might as well demolish it right away and demolish it before January 1st. So the tax much less.
But
so it's in the house anymore.
But then you'd have upfront, or you could delay the cost of demo if possible instead of doing it upfront.
Right.
So it's like
Exactly.
interesting.
So
See, it's all those details, all those mechanics
But
that there's so many variables, so many things that can go wrong as well.
I would say the same thing about value add.
That was a conversation.
So think of it, 1970s product. And I
Primarily our product, yes.
Okay, 1970s plumbing. How do you and even roof that you're like, oh yeah, I can get to the roof, but no, there's so many things that could go wrong with plumbing. And then sometimes you even say like, okay, well, let's put in $300,000 as a contingency for plumbing. Then the deal doesn't work. So I know, like, we need to know whether this is going to work or not. I remember we had a property that was 17 acres, and the plumbing had to be replaced.
All of it.
Yeah, it was already, we kept it for years and years and years. Okay. But after,
17 acres.
Yeah, 17 acres, the plumbing for that is so freaking expensive because the buildings would go from one place to the other. And it just all had to be replaced. Plumbing. Yeah, all cast iron plumbing in 1972 construction, I remember. So I mean, we don't have that risk in new construction because we know exactly if we're building from ground up, we know how much it's going to cost. The price per square foot is quite defined. As a matter of fact, as we get closer to each one of our projects, I can tell you right now we're at $167 per square foot.
That's what
not 168, not 166. And as I explained, it's a GMP contract, so they're gonna give us the keys for that price.
It's there.
That's there.
And if price of material goes up through the roof, it's
their problem.
It's their problem.
It's their problem.
How did they solve that problem? Just generally curious.
They have to do quotes.
I imagine they would have insurance for
they
that too,
they have a bond as well that protects them.
Right.
So they have a very big bond, and they have gone through this so many times. Again, they have sub vendors that they're giving them the price for each one of those things. So we choose which windows we want, and there's 3 different vendors, each one giving a price. And the cool thing, though, is that as a matter of fact, the price shouldn't go up unless there's change orders, which we avoid tremendously, but it can go down because if we are able to negotiate a better price than what the GC had with their vendor, like we bring a new vendor, we're allowed to do that. And we can, whatever savings, we can split with the GC 50-50.
Split it with the GC. 50-50.
So there's a value in doing that. So we have different risks. Again, like I do get asked a lot by people. It's like, Daniel, is this a good business? And they're asking me, I don't know, about a restaurant or about anything crypto. Crypto. Whatever. So I'm like, listen, that's a loaded question. There's no way of answering that. It depends, and it depends on the investor. It depends on you. Like, what is it? Like, because what you do, you have a threshold of risk that you're willing to take on certain things, but I'm sure that you don't want to take risks on other things. I mean, I can tell you that some of the developers that I know could be far more conservative than you are. Like, that they think that what you're doing is risky. And again,
perception.
Exactly. And then and perception starts changing when you have so much experience. So now that you know value add so well as you do, you're like, no, Daniel, there's no.
It's what and we've done it, and we've shown, gone full cycle on many. So it's like, yeah, it's kind of, it becomes second nature. Like, okay, we acquired a new one, boom, boom, have the guys, and
Exactly. You know what are your risks involved there? How to minimize them, mitigate.
Mitigated plan during due diligence. So we've scoped all the sewer lines, for example. That's checked all the roofs, electrical.
Both of us, of course, use spreadsheets, and spreadsheets are only as good as the input that you put it.
The data that
goes in. Shit in, shit out. But if you have good data in, then you're going to have a good result, and that's where experience comes in. Like, what number goes in. Like, what is the occupancy that you can expect? What is the cost that you can expect? Right. What is your CapEx, for instance? It's one of the big variables that maybe most people will have no idea in your business how to do, but you know how to do it. And or even, how about this one? Like, because you go through you do heavy value add as well, right? Heavy. So rents can go up as much as how in percentage wise, or from what to what?
Oh, we had the one in Miami has probably been the biggest in Opalaca.
Yeah,
it's probably been the biggest, where we took it from average $1,400 per month rents to now $2,000.
Well,
so that was a huge. Section 8 again, as I was saying, has played a huge part of that, because they're just paying way above market, and we're like, yeah, great. But on the flip side, it's not all what is it, roses and whatever they say.
Yeah.
Insurance has doubled. And that's something, well, we could go into that, or how much it has affected the real estate market in South Florida.
Exactly.
But just how much and we buy right. So fortunately, there's always so much spread because we buy at such a low cost basis. And we take contingencies into the CapEx, and then contingencies, surprises like these where insurance doubles.
Yeah.
So, but fortunately, again, we keep the metrics and the KPIs we use to acquire in a certain way, that when things like this happen, we can absorb it and still be above water.
Exactly. But still, even just that number on the rents, I mean, you're going all the way from $1,400 to $2,000. First, sounds tremendously sexy, of course, because I'd love to get into a deal.
It was a lot of work too.
Yeah,
it wasn't,
But it also sounds a bit scary. It's like, can that really happen? Like, I know for you, it's like a very simple analysis that your market, and you're like, of course it does. Because as my father once said, is like, oh, you can take this from $1,400 to $2,000. Then why hasn't the other guy done it before? And it happens. It does happen. Like, I gotta say that's the beauty about this business. There's opportunities out there.
It's a big one, and it's not common, that kind of increase.
Yeah.
But we took an asset that was heavily distressed, kind of from a D class, I would say, to a C. Nicer people with, families want to live. The bad actors that were at the property no longer there. So people are willing to pay a premium in that area for, fully refurbished stainless steel appliances. We put a gate up front, security cameras everywhere. So now it's safe versus before it was actually, kind of the properties that have the iron, not fence,
Bars.
iron bars in the windows and whatever. No, now it's not that kind of place. So
Interesting. Okay. So, but you haven't ruled out then that you might get into construction one day?
No, I don't rule out anything.
Okay, good.
Because it was interesting versus you, and that does seem safer. You were saying the same, similar to the dollar amount your construction cut 167 per square foot, whatever that is, per project. Your projected rents will also be that dollar amount plus minus a very small margin.
Exactly.
So it is a more, what's the word? I guess
precise.
What you're getting in the end.
Yes, it is. There's also
the fact that there's less fluctuation, even if it's higher. It's a risk. People can perceive it. Investors can perceive it as, it's higher risk.
No doubt. Let's talk about one number that kills or makes the deal. I think you know what it is. Cap rates. Mm-hmm. So cap rates, you need to have a cap rate for an exit. And let me explain for those that are not familiar with the term. So in multifamily, you would have income minus expenses. That would give you your net operating income. In expenses, you do not include debt service nor capital improvements. That's a line below. So it's just operational. So you have your net operating income. That net operating income, if you divide it by the value of the property or the price of the sale of the property, that's going to give you a percentage. Typically, it's a number between 5% and 10%. And that's what we call the cap rate, which is or capitalization rate, which basically tells you how good or bad the deal is without taking into consideration leverage. So that's an easier way to compare one opportunity versus the other. And you use that formula, the cap rate. How do you use cap rates on your exit or on your acquisition as well?
Mostly on our exit. We don't look at it so much because we're heavy value add investors. What it is now, I am looking at what is the spread where it will be in the end. And so we look at whatever the market capitalization rate at the time of acquisition, and then just probably drop, change about 25 basis points what it will be in the future, just as a margin of error.
Okay.
But going in because it could be a negative cap. Like right now, it's not making money, but once we do all these things, this thing can be printing money.
Yeah.
And we take it from our Opalaka asset. We bought for 5, and recently we're going to refinance at about 70% of the appraisal. They haven't sent it to us yet, but we know it came in close to 8. So we took something in 2 years that was valued at 5. We bought it for $5 million.
Yeah.
It is now worth 8.
Okay.
So, and that's our business strategy.
Okay. Got it. Hey, why don't you, share with us maybe a fun story or a horror story on anything that you have to do. It could be involving anywhere from residents to investors to anything that you might want to share.
We've had, let's see, don't buy Class D assets. So the only one we've ever owned, which is in turn the only one we have sold so far, was exactly that. Class D asset. And something to point out, short and sweet, with the Class D assets, we fixed it. We took one of them, fixed it, made nice, put a couple grand more into it to charge an extra $25 a month in rent. They wouldn't move in. No one would and this is in Arkansas. It's lower rents. So from 600 to 625, no one would rent it, even if it was nicer. 600, we had to rent it at that. But at that property, we had a guy altercation, shoot and kill the guy in the parking lot. Police come. I get a call. Hey, this is happening. Do the cameras work? No, they're duds. the police is asking. He's like, yeah, he shot, this and that. I'm like, okay, call Dave. I'm like, call Dave. Have him go with the pressure washer and clean up the blood, please.
Yeah.
So that has happened. People go in and steal stuff.
Were those residents the ones?
That was a resident. Altercation with another one in not our property, but came over. And
Well, you remind me of a scary story that happened to us.
You owned in Opelika, so
well, actually, this happened in Opelika and in Port Said Road.
In Port Said,
yeah. We had 24 units apartment building.
I know exactly which one.
Oh, and
it's for sale now. I know.
Oh, really?
yeah.
Okay. So New Year's Eve. I believe this was the 2000 New Year's Eve. Yeah, and I was traveling, and I get the call the next
2000, day. Turn of the millennium. New Year's Eve.
Yeah, and there was at 11 p.m. or whatever the time was. Then this guy, resident, with a weapon, with a permit, decided to start shooting. At the celebrating for the New Year's. And then the residents would tell him, like, hey, listen, stop doing what you're doing. Like, bullets come down. Like, that's dangerous. Like, don't do that. It's like, okay, fine. So he goes to the parking lot and shoots the garbage container. Like 3 shots. Well, there was a 10-year-old that was playing hide and seek. He killed the child. And this is I tell this story, which is very harsh, but it's liability insurance. It's so important.
You got to have
You got to have liability insurance. The first thing that they ask you is like, do you have security over there? It's a 24-unit apartment building. You don't have security on something like this small. Why? Again, the guy had a permit for the weapon. He was arrested, manslaughter. The insurance ended up paying, reaching a negotiation with the mother. Very unfortunate. But these are the type of things that will happen, could happen. Plenty more stories, I'm guessing that.
Oh, yeah, I could tell a whole lot more. I mean,
tell us a little bit. Why don't you tell? Are you working on doing an acquisition right now, or are you going through the process on a particular building? And maybe you can walk us through what's going on.
We're financing the building in Opelika. We'll be refinancing a couple more first quarter next year, and we are acquiring a couple of assisted living facilities in South Florida. Early in negotiations, waiting on financials from the owners. The difference is so we talked about how multifamily, we kind of all know each other. It's a niche.
Yeah.
And then with assisted living, it's even a niche of a niche.
Of course.
So like with this one, we personally know the owners.
Can you explain a little bit what that is?
Assisted living facilities. It's, people where, that need help with activities of daily living. With one of the 3 of the 5 activities of daily living, they go into a facility like this and they live there, they're fed, they're, taken care of, laundry, etc.
Guessing rent is so much more high.
Much higher. It's a whole different business. But and we kind of came to the one we own in Pompano sort of by accident, but the numbers were there, and there was the right management company and the right partners that also kind of came in, and they, as we didn't know the business at the time, it's like the one person that knows how to keep residents in, and the one person with the agency, because it's a heavily regulated asset class for obvious reason.
Yeah.
That knows that side of the business. She used to work for ACA, which is the regulatory entity, and so she keeps us out of trouble there. So, long story short, that's how that asset happened for us, and we've liked it so far, and look to continue doing more of those.
Interesting. So, interesting. Good. So as I was saying at the beginning of the conversation, on our end, we have 4 projects here in Miami. One of them is 110 units in Fort Lauderdale. We're starting groundbreak in 2 weeks or so. Don't hold me to it. But then we have 240 units coming up in North Miami. That was an interesting project where we're getting a little bit of help there with Live Local Act. So that's something that really helps developers right now in terms of density and then a property tax reduction. Then we also have the 644 units out of Hialeah that we're building. And we have one more project near Brickell that's probably going to be between 300 and 400 units. We don't know yet. We're also using Live Local for that purpose. So
what do they do for you exactly?
Live Local?
Yeah.
So Live Local was a bill that was signed last year in July by Governor DeSantis, in which they are trying to address the housing crisis that we have in Florida, the shortage, to be specific. And the way of doing so is incentivizing developers to build more units. How they do it is that they're allowing two things to happen. One thing would be density, increase your density to any other building that has within a mile from your property, you can increase the density to that same number of units. So for instance, we're on the roads, but we're less than a mile away from Brickell. So we can use 1,000 unit in density instead of 150 units. So which was the approved density for that particular lot before this law came in. Now you have to, for doing so, you need to set up 40% of the units need to be affordable housing, or which not affordable would be workforce housing, which is 120% of average median income or below.
Got it.
And for some of our units, that's very easy threshold to make. For instance, the ones in North Miami would be the easiest one. And then Hialeah is very close as well. And so that's the component on density. But besides that, every year we will get audited to see how many units we have rented. And as long as we have more than 70 units in the building, we would get a tax abatement, a reduction up to between 75% to 100% to reduce our property taxes. So these type of things, if the operating expenses account for 35% of or 38%.
Then you were asking me about our underwriting. Like we just do a straight 40. So
40. Okay.
I'm doing a quick underwriting, I'll go 40.
So 40, we're able to reduce that by 8 points. So
substantial.
The property taxes. So it's substantial. So we're working on these projects again, levering on now the government that's assisting us on this. So those are the projects that we have right now. I believe we only have like 2 more minutes. I want to wrap it up.
I think she said 30.
Oh, okay. Then never mind. Okay, we had more time.
Because I have a good point there. Since you mentioned that, and this will be valuable for the people listening. And thus another reason. You mentioned the government they're more involved in development.
Yeah.
To many extents. City commission, planning, all these different governmental agencies, local, state, probably not federal, I don't know, FEMA. Quick story that someone I personally know, doing a development up to horizontal, going to sell to D.R. Horton, one of the big builders, home builders.
Yeah.
Long story short, after city commission had already approved X amount of houses, one vote in the commission, however that works, changed it, and now they had to have more space within the houses. So now they can't build the 100 plus they were planning, but they came down to 90 something. Okay. Thus, heavily now, that's eating their profits and might now even lose money.
Wow.
Things like that in development.
Sure.
That are out of your control. What do you do?
Yeah.
So
you're right. And those things happen, no doubt. Something like that in particular hasn't happened to us yet.
Hopefully it never does.
We try to do our due diligence and take and try to. We even meet with city officials.
Of course.
And for instance, the deal that we did with in Hialeah, we ended up meeting with the mayor. I mean, 644 units is a big deal. So we were able to get
the city.
Exactly. So we were able to meet with them and get an understanding, like, what are their interests? Because if things happen, it's like, do you guys have our back? I mean, are you going to be supporting us on moving this forward? Are you going to help? And it so happened that they did. Like with this project, for instance, had to be voted, had needed 5 votes from commissioners twice. So we had to go through the whole process twice.
And as you go, stand in front. What is it like? They do a meeting
so
at
it's
City
supposed,
Hall,
yeah,
right?
exactly like
you
that.
Gotta be there,
right? But then, and I was there, but our attorney was the one doing the presentation,
doing the talking.
Yeah. Funny thing is, the commissioners started asking questions as to, and it was a good, decent question. It's like, well, no, I'm sorry. I'm going to start with a silly question that I believe one of them asked is like, well, why are you building in that lot instead of the one east? We didn't own it. But and then he kept insisting, like, well, I think it would be better to build more towards the east. It's closer to the train station.
And you're like, I'm sure it would be, but I don't own that land.
Exactly. So, but good thing was that the builder, who's an amazing, rep over there.
JC was also present.
No. The building official. The building official. Okay. The city buildings official stepped in. Like, she stood up from her seat and it's like, listen, that's the plan. They have nothing to do with that land. But so she helped right away answer the question, what he was trying, the answer that he was trying to find. He got it from her, straight from her. And then we got approved. So
what if that hadn't happened?
I don't know.
Things like
I don't know. I mean, maybe we wouldn't have gotten his vote, but there was still majority vote. Because there's 5 people.
And does it just need to be a simple majority, 3 out of 5?
For that one, it's a majority, and we ended up getting unanimous vote.
Okay.
So on both of the times, and again, this is a city that's pretty much controlled by the mayor. He was on board with it. He,
heavily influenced.
I'm guessing, yes, they might have had the conversation even before voting happened. That's, inside door, so I don't know the whole story. But they had those questions, but as soon as we answered, we were able to push ahead. So again, we do have risks, no doubt. Then there will be some implied risks in development, but we try to mitigate them by doing as much due diligence as we can, by having experience on those specific numbers from other projects, on having the data, for instance, that we have on 5,400 units that we can use and say, like, okay, we expect this utility expense to be this much for the city. So it helps. It helps. And cooperating with people like you as well, like that, exchanging notes. I mean, I don't have no issue with that as well. We exchange notes with builders all the time. Like, how much was your park? How was your? I think the last question I was asking to another developer friend of ours was their cost per parking spot on a parking spot. Yeah, and they gave us the same number we had, which was $26,000. But it's good to know. It's like reassuring.
Yeah, exactly.
Reassuring. So it's like, oh, okay, good. It's not 35,000. So because and then these happen, these things happen like that. But what questions do you have? Maybe for
we can keep going. I can keep going for all day. But so you're doing the project. That was something I was very curious on our last conversation. Is you're doing the project in Pompano, the condos.
Oh, okay. Yes. So that would be the exception to the rule of what we typically do.
Different
we have, right? So we're doing the Armani in Pompano. It's it's a very curious project. It has a blend of good and the good and the bad. I mean, the brand is incredible. They already have a very big building, which is the one in Sunny
House. That's my view. In
Yeah,
the morning, too.
exactly. This one is a boutique building, so it's very different. I wouldn't even be able to compare them.
Because the footprint is small.
Right. We're just 28 units on 2 buildings. So it's 14 units per building and 1 entire apartment per floor. So as we have 2 elevators for each one of the buildings. So there's never going to be congestion in the elevators, which sometimes happen in other projects.
Right.
For us, this is more of a boutique experience, more of a private experience. You have amenities. They're not humongous, like the ones that you would find in a 300-unit apartment building, but they're far more private. Like you might be at the pool just by yourself, So those are the type of things that we liked about the project. Is on the water in Pompano.
How do you choose those things? Like that was...
No, this one kind of happened. This one kind of happened. Like this came from a 1031 to a purchase. So it came over from years back with one of our longtime investors that we've had, for 20 years, more or less. He's invested with us in several projects. And as we sold one property that we had in Miami Beach, then we turn it over to the next lot. Then to save on the 1031 exchange. And let me do a quick explanation. The 1031 exchange is a provision in the IRS in which an owner of a property, and it could be a single family home as well, that when they sell, they want to, let's put it in lame terms, is kick the can down the road in terms of paying the taxes for it. So you don't get a reduction in taxes or anything like that, but you have, you can take those taxes that you're going to be paying towards the next property. So on $1 million property that you sold for $500,000 gain at $1.5 million, instead of paying taxes on the $500,000, what you can do is buy a similar property for the same price or more, and then under the 1031, and that needs to happen within 180 days, and it has another set of rules that we don't need to get into.
Find the property within 90.
Exactly. Find the property within 90. You identify the property. So you identify 3 different properties, and then one of those has to be the one that you end up closing within 180 days. So we were able to do that with this. So we kicked down the can and you can do it several times.
That's why you're just delaying, but you keep delaying as long as you keep buying.
Exactly. So the next one was $1.5 million, but now we sold it for $2.5 million. So now we have to pay taxes on $2 million.
Gain, right.
On that gain on the original one. We still owe the $500,000. So
you just got to keep buying bigger every time.
Exactly.
Now developments also come in. That's actually something I didn't know. You can also 1031 into a ground up development.
You can, but you have to own the land. That's the tricky part.
Okay.
So if it's not like an investor can come up and say, "Hey, Daniel, I am selling a $500,000 home and I'm going to have a $200,000 gain. Can I do a 1031 with you on your next lot?" I'm like, "No, we can't, because that LLC needs to buy the land." So it would have to be like. It will have to be me. Like if I was doing it personally, or my own company had a lot and we were selling it and we wanted to do the 1031, we can do it that way. But we can't bring somebody else's property or LLC. It's the same LLC, same ownership.
So unless he was doing it himself, what about if that the owner that sold the other property, he's buying a piece of land just buying for himself or without. For the purpose of doing development. Just for the purpose.
Of course. Yeah.
Still do the 1031.
Absolutely. Yeah, absolutely. You can do that, and you can definitely do that. And again, we're not accountants, so I'm not giving
not
financial advice or an accounting advice, nor are we attorneys either. But so we were able to get to this property that way. And the entitlement process for the Pompano took 4 years. It was a huge fight with the neighbors.
4 years.
We didn't know that was going to happen. Now, for the good and for the bad, because as the market changed dramatically in 4 years as well.
When did you buy? When you close that one?
We bought the land, I want to say like 7 years ago. So no, 6 years ago. 6 years ago, we did the 4 years went through, and then 2 more years on the entitlement and permitting and so forth. And while those 2 years happened is when we did the partnership with.
So the good news is that land just by itself as is now worth a whole lot more.
Hell a lot. Like
now you wouldn't sell anyways because you've kicked the can over 1031s. You would have a tremendous tax bill.
Yes.
Of
yes.
this capital gains and all the previous ones.
Yeah, we're not going to be able. We're not going to be able to kick it any further because this is a condo project. We have to sell.
And that was going to be my next question.
Yeah.
Because it's condos, how does that all play? Or now?
No, and we just sell. We have to pay the taxes on it. It's like there's no way around it. There's one more thing in real estate, and this is the beauty about investing in real estate. There's so many benefits from capital. I'm sorry, from taxes. There's one more that's called an opportunity zone.
Yes.
So opportunity zones is where you bring the gain. This is the interesting part. So you don't need to bring the whole investment like you had to do on the 1031. Like the example that I was giving, you would need to buy something for more than $1.5 million. For an opportunity zone, you can just bring the $500,000, and it doesn't have to be a real estate gain. It can be a gain from any other type of business, even from shares.
You can offset it off of any capital gain activity.
Exactly. Any capital gain activity, you can just bring it into the opportunity zone, and it's going to have two effects. One is going to push down your tax bill for those $500,000 for your gain all the way to December 31st, 2026. So you don't have to pay that right away. You get a couple more years. And the second effect is that if you keep that property for more than 10 years, once it's developed, of course, and everything, you keep it for more than 10 years, you're tax-free on that. You don't have to pay any taxes on that gain.
No kicking the can. It's just...
That's it. So
nice. But you have to own it for a decade.
Yes. So that's the thing. How we try to engineer this is have maybe 3 projects that are giving us a substantial capital gain, and then wash that through an opportunity zone.
Investment.
Exactly. And then just keep that money there. As you know, if we needed some funds, we can always do it through a refi instead, because you don't get taxed on a loan.
On refi proceeds.
So it's a beautiful business in all the ways. One more thing also, now that we're talking about taxes, is depreciation.
Yeah.
So you have the 29 and a half years, if I'm not mistaken, 29?
35,
39 for commercial and 29 and a half, I believe it's for residential. And you can depreciate your buildings at that linear number if you divide it by 29 and a half years,
or accelerate it.
Exactly. So with us, like, we heavily invested since our buildings have elevators, have electrical components like entry, access systems, cameras, anything like that, we can depreciate that at a much faster speed or pace than bricks. So those can be at 5 years or 10 years. So what ends up happening is that our first 3 to 5 years have a heavy depreciation that translates over into negative K1s for our investors that they can use against their gains on any other business. So this is quite interesting that you can invest money into a project like this and then actually get a benefit while you're not a monetary benefit right away. With yours, they do, of course, because you're receiving
distributions. Yes,
but for us, there's no particular gain in the first few years, but you at least get the benefit of receiving these negative depreciations.
Yeah, there's investors. We have a couple of investors that they just want that, or that's their main reason for investing with us. More than the distribution, everything else, they're like, oh, that's fine.
Okay, good.
They want the negative K1.
Well, Julian, I wanted to wrap up a little bit. I don't know if you have any something else that you would like to say, you would like to explain, that anything that might, or that our audience, like one thing is misconceptions that we have about this business, anything that you might want to, about your business, I'm sorry, in particular.
Well, mine in value-add real estate misconceptions. I'm trying to think, what could it be a misconception? We were talking about, or I will point this out again, that the high rents we've been getting, for example, in some of our assets, but then there's all the other costs that also get increased. So it's not all, fun and games all the time, because there's a lot of things that we go through and extra costs that are not added. So it's not
that's a really
collect
good
rents and that's
yeah.
it. So,
Everybody thinks like, rents was spiked in the past 2 years, I don't know, like 28% in just in Miami. It's so did the insurance.
But insurance doubled or tripled.
Exactly.
In some areas.
In some other expenses didn't go up as high, but just insurance was so much higher. So that's a great misconception. Yeah.
Rates went up, so there were many, like, we fortunately, never went down that route, but there were many operators that took, floating rate loans. And when, rates went up the way they did the last couple of years, they found themselves in a lot of trouble as well. So a lot of pros and cons to this business. It's not rocket science either. I was having this discussion with someone at a conference last weekend, and we're not sending people to the moon, but there is, you just at least be competent or care enough to, create a good place for people to live and provide a good service that people, would want to buy from you. So I will say that. And no, in terms of what you do, I could keep going on and on with questions. Like, that was a thing with the Armani. These brands, how do you find who is at Armani selling their brand, to developers? Like,
okay,
this became a thing.
Relationships.
Yeah.
No, we have it's incredible because a building,
because people may be generally curious by this. There's so many branded buildings coming up.
Yeah, the way that worked was through relationships. So the broker that we chose to handle the sales, he had an existing relationship with the brand. Armani. It's like, would you guys consider that? Because
he brought it up. It's like, hey, this would be worth
the price
more if we put.
Yeah, the value of the condos increased at least 25% just or in a number like that by the use of the brand. Now, we did change the project significantly as they came in. So there were other costs as well involved.
Because now you have to...
we have to use everything that, like, all the interior, it has to be Armani. So everything that we use is Armani based.
And the ambiance and the per se, it has to be feel like Armani of the property or whatever that
everything about it. And they're tremendously specific.
I'd imagine.
And amazing taste, no doubt. But we did have a very different project planned out. We were thinking about sales at a very different value, and this kind of changed the project, even though we didn't change the cocoon of it or the exterior of it. We kept that very similar. The footprint very similar, number of units, all of that, but all the interior they have been getting into very fine detail.
Well, and you were telling me too, depending on other variables, I mean, you have projected what they can sell by, but this one has a lot more room. It can potentially be a lot more because the condo market is a whole different.
Yes, condo market is a very, I want to say that pricing at this level, it's almost like art. Like, how would you value
art? How
would you value a piece of art? Like, when they tell you, like, this Renault is $20 million. Why not 18? It's like, why not 22? So it's, I don't know that there's like spreadsheet guys behind those things. I have no clue. I mean, you and I know that our business is it's numbered. Like in multifamily, it's 100% numbers. In condos, there's a more of an artistic perception. And sure that there are going to be comparables in the area, and each one of these sales is going to involve an appraiser and a bank, and they're going to need to make sure that it's valued.
That remains the same. But so what if, like the first few, here's someone comes in cash and just wants a handful of them and just pays an exorbitant amount of money.
Yeah.
And now that's baseline. You know what I mean?
That happens all the time. That happens all the time because projects like these have been planned for years. So
4 years.
Yeah, exactly. So, I mean, you don't want to do something illegal like have a friend, buy it as a favor, but you want to find that buyer, the cash buyer that sets the price. And it doesn't even have to be that many units. It could be as many as 2 closings, hopefully 3.
And now that's the comp.
And that's the comp. Now, the difficult part, though, is that whoever brings in cash and wants to do a quick purchase, they want a better price. Now,
but you know what I mean?
It's yeah.
But that could determine
But
it's so subjective.
It is.
So, appraisals have always been a thing for me. It's like, it's the most subjective thing in the world.
And they make it even more difficult on the newer projects. Like, for instance, I was very recently, I visited the one in the Bentley.
Okay. Yeah, you were telling me.
Yeah.
With a friend.
Yes. And the Bentley is shaped weirdly because it goes from
like
very wide to just narrower, and then again goes wider. So every balcony is different size. The units inside are fairly different sized, and they do this on purpose because then no unit is equal to any other unit. Like in other words, you can give that artsy component of pricing so that each one is unique. So it's like you can't compare the price of this one because this one has, in the middle, the ones in the middle, if I'm not mistaken, are the ones that have the biggest balconies.
Okay.
But
the kitchen island
but it's very completely different. So it's like you can't compare that one to the one on 20 floors up. Also, because now that one is 20 floors up, has a smaller balcony, but it has this other but the view is better. So everything is so subjective to taste, and then that way is a bigger challenge for appraisers or for even banks to decide, like, how much is this really worth? Is it just price per square foot? It's not.
Well, and then you're building something. It's condos. Is it still a commercial real estate asset, or because you're building? We were talking market capitalization rates.
Condos are considered commercial as far as the development goes, and then residential as soon as sales start.
Okay. So how do you value? You know what I mean? It's harder to value.
You mean our pro forma? How do we?
Correct.
Yeah. So it's very difficult. Very difficult. We do have a pricing sheet for each one of the apartments that has been discussed for as long as this project has been up and refreshed as many times as you can possibly imagine, and changed and modified, and nothing about it is it's cut and dry. It's more like an art trying to decide like how much is this particular condo we're going to sell it for. Because again, we have 2 towers as well. So you can't compare, even though they're very similar in square footage, which they're not equal. I know that they're not equal, but they're going to be similar in square footage. One is going back, one is in front of the water. So those are going to have different views. They're going to have a very different setup. So all of these things are taken into account. But then it's subjective. Again, we don't know. That's the risk of doing a deal. A condo. We understand that, but again, it's a small project, 28 units. We just need to find the right buyers for it. 28. It's not so. The idea is just to sell. There's plenty of buyers. It's an amazing location next to the private airport in Pompano, and this is becoming the thing now. Like Pompano has now. I mean, I know that Miami has its thing.
The city of Pompano is doing.
Yeah, it's doing amazing.
They're trying to revamp, completely change the perception of the city.
Yes. You have a property there. Huh?
The assisted living facility. Yes.
Okay.
We own right off on 8th Street. So, yes.
Okay, good.
But so, I mean, economic downturns in development and then in condos, potentially, how do you hedge against that?
So, first point where you have to do your hedging is on your pro forma. So even if we were willing to sell 1 month after completion, give yourself 1 year and a half to sell on your numbers, so that you have that timeline to be able, that flexibility.
Okay, so take into account an extra year and a half of holding costs.
Yeah, so holding, and we're going to be renting at that point, so we're going to be receiving income. So it's not that terrible to have to hold for an extra year. But this industry is very cyclical. Like it has its bad turn. Like you don't want to sell when stuff is in a bad position. You want to try to maximize your returns. And it's a sweet combination between how long are you willing to go, because money costs. Can you? As well, because of your compromises with your investors and so forth, or because of your loan or your debt that's going to have a ticking time, it's like ticking bomb there. And we do that with our debt as well. Like we have that flexibility. So we want to sell when the moment is right, and it's not going to be. So for that, it's just plan ahead. How about you? What do you do?
But again, see, with developments, it's just a lot longer horizon, and so many things can happen. Whereas I believe with us, where the basics and the fundamentals of the business and how we acquire, as long as they're maintained, we see, okay, and that's our underwriting. Hey, worst case scenario rents, or we take it as baseline. This is what they are now. Okay. And let's say we can't raise them so much, or like as much as we have, for example, in the Opalaca asset. Do the fundamentals still work? Do the deals still pencil out? Do we still cash flow? So that's kind of how we've operated.
Okay.
Because again, we're not at such a long time horizon. We can see, okay, this is what the market is now. And worst case scenario, I mean, rents don't go down really.
Yeah.
It's
that's the thing. Incredibly enough, sale prices are far more flexible than rents.
Yes.
And this is what happened back in 2007. I remember.
You've been through it.
I've been through it. Yeah, I've been through
20 some.
Yeah.
How long you been in?
I've been in real estate since 2001.
01.
See, yeah, so 24 years. 23 years now, and I remember this particular building in Brickell. It's called Brickell View. It doesn't have a view to Brickell, and it's view spelled VUE. So, but anyhow, like through this craziness that happened, this was probably the epicenter, because everybody thinks that as of real estate that there's that the epicenter of the whole turndown of that crisis was Florida. But out of Florida, it was Miami.
Specifically Miami.
Yeah. Okay. And then out of Miami was this building. If you have to put it like right there, like where did this earthquake started? It was like the story that came from this building is like at its highest point, units were selling like a studio or a 1-bedroom unit for $850,000. And that same unit, yeah, and it sold for $160,000. So the discount that the bank had to take, the delta, was unbelievable. But somebody in New York probably underwriting this like, oh, this is Brickell? Okay, must be worth it. So it was such a a crazy time to do real estate. But so the prices really came down almost 70%.
That's crazy.
But rents came down at most maybe 12%.
But rents did not.
So we are in a business that's safer. Like in terms of we're not playing with inventory. We're playing with something that makes money, that has a return. Anyhow,
we're getting the signal.
Again, Julian, I greatly appreciate your presence here, and then in having a chat with you. I think I could go for hours as well. But hopefully, anybody that wants to ask questions, do it in the bottom of the video, and either Julian or I can start answering those.
Yeah, and reach out to us or to social media
as well,
channels as well. All of them, JulianSanchez.biz.
We'll be copying your links on the video as well, so everybody can access and follow us. We want to bring more content.
We're local here in South Florida, and we talk real estate.
Thank you again.